Hi everybody, this is Phil Holoka from Complete Captive Management Services, and today we launch our next three-part series on collateral versus capital. What's the difference? Well, that's a very common question. So how about we define them? So collateral very easily is defined as an exchange of value between two entities. And most common, it's between a bank and the recipient of the loan. So in other words, I apply for a business loan from the bank, and that loan value is for $100,000. However, my signature on that loan will not satisfy their credit requirements. I'm not creditworthy. Therefore, I have to post an asset of mine to the bank to protect the bank should I default on the loan. And that collateral could be my 401k, it could be a deed to my house, something to protect the bank's interest. So that's really the simplest explanation of collateral. Capital, on the other hand, is more of an equity discussion. For example, I invest $100 in the business down the street. My $100 is reported on the business's balance sheet, $100 cash. And then I will receive some sort of stock certificate in that business, and that's reported as shareholder equity. My goal is to put that $100 to work so I can earn a return. This is all equity, okay? So capital is mainly equity into another business, okay? It's my basis. It's my investment basis. For insurance companies, it could also be labeled as surplus, okay? Now, collateral with captives. Collateral is most likely associated with reinsurance captives or fronted captives. The collateral is defined and demanded by the fronting carrier, okay? We're going to talk about this in more detail next week, but for now, just accept that the reinsurance captive will post collateral to the fronting carrier because the captive is not creditworthy or investment grade in the eyes of the fronting carrier and their shareholders and their reporting requirements. Okay? Capital for a direct writer, again, more closely tied to equity. Your feasibility study, the captive's feasibility study, will define the capitalization requirement. However, the regulator has final say. So your feasibility study may express $100,000 of capital is enough, but the regulator may say, no, $200,000 is what's needed. Therefore, if you want a license in that domicile, you're going to have to capitalize your captive with whatever the regulator responds as being needed. Okay? Cash. When the captive, the reinsurance captive, posts cash or collateral, that cash is deposited to the fronting carrier. That cash should earn interest with the fronting carrier because you know if your cash isn't earning interest, it's actually losing money. Now sometimes a letter of credit can satisfy the collateral obligations of the captive to the fronting carrier. Okay? Cash with a direct writer captive, that cash sits in the bank account of the captive. That cash can be self-directed, meaning the owner of the captive can invest that capital within the framework allowed within the investment policy statement, which, oh, by the way, the regulator will approve. The investments of the capital within a direct writer captive are generally high security investments, money market, government bonds, high grade corporate bonds, and the like. Now, if your captive participates in a risk pool and the risk pool takes on a portion of the risk, the direct writer captive may have to post collateral to the risk pool. So there are elements of collateralization within a direct writer captive, and we'll talk about this next week, there may be elements of capitalization within a reinsurance or fronted captive arrangement. More to come next week. So, hope this was helpful. High level stuff. We'll talk to you next week. Bye now.